In today's video, we're going to learn how to perform complete market structure mapping under the smart money concept. So, let's first break down market structure. The market generally has three main phases or structures. A bullish structure, also referred to as an uptrend in price action. A sideways structure, and finally a bearish structure or downtrend, which we observe on the chart. If you understand price action, then whenever the price pushes higher by forming higher highs and higher lows, an uptrend is in progress. In a sideways market, since nearly equal highs and lows form on both ends of the chart, we don't see any clear trend, leading prices to consolidate within the same range. On the other hand, whenever a sequence of lower lows and lower highs develops on the chart, we identify that as a bearish market structure or downtrend. This is the most straightforward way to interpret the ongoing trend or structure in the market, which is essentially price action. While analyzing charts in SMC, we rely on break of structure for mapping market movement in SMC. And change of character requires focus on these two aspects. Let's dive in. But before we proceed, if you find this content valuable, make sure to hit the like button. And if you're new here, don't forget to subscribe and turn on notifications so you won't miss any of our future uploads. I'll meet you right after the intro and disclaimer. So, let's first clarify what a break of structure actually means. In this case, the market is trending upward, creating a sequence of higher highs and higher lows. Within the smart money concept, whenever the price surpasses its previous high, trades above that level for some time, and then moves back downward, we call it a break of structure. This occurs because the market had already created a swing high in this manner, forming a recognizable pattern. Now, as the price climbs again from this lower point, the previously formed structure is broken, which results in a new high being established and a fresh pattern appearing on the chart. In this way, the price continues rising while forming higher highs. In price action, whenever the market behaves in this fashion, we refer to it as a chart pattern appearing on the chart. Whenever the market invalidates its earlier pattern and generates a new one, this is called a pattern break in the language of price action. However, within the smart money concept, the same idea is described using the term break of structure. The terminology is heavier, but the underlying principle remains nearly the same. Whenever the price breaks its old high and then retraces downward by at least 50% from its earlier swing high, we consider this a valid break of structure. Here, the previous high shifts forward and transforms into a new high. When the market rises from a low, breaks through its recent high, and then declines again in the same manner, the earlier swing low shifts forward into a new swing low. The pattern created in this way is known as a valid break of structure, where the market pulls back strongly before resuming its upward direction. Yet often, when a strong uptrend is in motion, the price may dip slightly before pushing higher again, resulting in what looks like a shallow pullback. Many traders new to SMC mistakenly treat such corrections as valid pullbacks, but this approach is incorrect. A valid pullback occurs only when the price breaks its old swing high and then retraces downward at least 50% from that swing, touching its earlier swing low. Anything less cannot be considered valid. To verify, traders often use the Fibonacci retracement tool. If the market is in an uptrend, applying the Fibonacci tool from swing low to swing high on the chart shows that unless the price reacts around the 0.50 or 0.61 level, it is not a valid pullback. Pullbacks of this kind are also labeled as deep pullbacks. After such a retracement, if the market breaks its previous high and climbs again, the old swing low shifts forward into this new swing low. Similarly, while mapping market structure, swing highs and swing lows continue to shift forward. However, at times, the market only makes a minor correction downward before continuing its earlier trend. In such shallow pullbacks, price reverses either at or before the 0.38 Fibonacci level. These are known as shallow pullbacks. When a powerful trend is active, the price often pauses briefly, leading to this type of movement on the chart. For this reason, we do not include lows formed by shallow pullbacks in structure mapping, since they are not valid retracements. Now that the concept of break of structure is clear, let's now explore what defines a change of character in SMC. Here, we'll again take an uptrend as an example. In an uptrend, Whenever the price advances by forming higher lows and higher highs, consistently breaking past earlier highs, we recognize it as a strong uptrend. The price moves upward from lower levels, repeatedly surpassing prior highs. However, at some stage, instead of breaking above its previous high, the price breaks below its prior low. For some time, the market had been in an uptrend, with price forming higher highs. This shows the market was behaving in a bullish manner, continuing in the same direction with the same pattern. Its character was bullish. But once the market breaks its prior swing low instead of forming a new high, it signals that the market has abandoned its bullish nature and has shifted into a bearish structure, reversing its earlier character. Within the smart money concept, this is described as a change of character. Some traders also refer to it as BOK or CHO. To simplify, on the left side of this chart, the price is trending upward, so its character is bullish. On the right side, the price is trending downward, so its character is bearish. However, after a certain period, instead of continuing its earlier pattern, price flips its behavior. For example, while in a bullish phase, it suddenly begins to form a bearish structure, or vice versa. This shift is called a change of character. Here, the price continues advancing in a bullish trend by breaking past its earlier structures, where after each valid pullback, we shift the previous swing low forward. Eventually, however, the price fails to break its prior swing high and instead drops below its earlier swing low. Rather than pushing through the previous high, it breaches the former low once again. The formation of this pattern on the chart is what we call a change of character, since the market here has abandoned its bullish structure and transitioned into a bearish one. We can also interpret change of character as an early sign of a possible trend reversal. This means that if such a shift in structure appears on the chart, the market may no longer sustain its earlier trend. By creating a fresh low, the chances of a new trend beginning increase significantly. This helps you adjust and plan your trade entries accordingly. Now, let's move on to understanding how to identify which break of structure and change of character are valid, and which are invalid. Here, the market is trending bullish by forming a structure of higher highs and higher lows. First, the price breaks above this high. Then while retracing, it attempts to surpass its prior high with a pullback, creating a long wick candle near that high on the chart. However, this is not considered a valid break of structure because the candle did not close above the previous swing high. In the smart money concept, this is called a liquidity sweep, since the market is attempting to capture sellers' stop losses positioned around that high. After some time, the price makes a small pullback and then moves upward, this time closing a candle above the previous swing high. At this point, we can confirm it as a valid break of structure. Once a valid break of structure is identified, we shift the old swing low forward to this new swing low. After a while, the price again retraces and approaches its prior swing high. It attempts to break through, but once more the candle fails to close above that high, causing the price to drop sharply. This indicates no valid break of structure occurred, which means there is no need to shift our old swing low forward. Until a valid break of structure is formed on the chart, we should not move our previous swing low from its position. This rule is crucial to understand, as only then will you be able to map the structure on the chart accurately. Now, our swing low remains at its earlier position. But here, instead of breaking the swing high, the market, while following its bullish trend, breaks the swing low. This indicates a change of character, suggesting the possibility of a bearish trend forming. Since the price closes a candle below its old swing low, this confirms a valid change of character. Later, the price pulls back upward before dropping again, breaking its prior swing low in the process. This confirms the formation of a bearish break of structure. Is this pullback valid? To confirm, we use the Fibonacci tool once again, since the market is now bearish. Therefore, we plot the Fibonacci tool from top to bottom. Observing the chart, we see that the price reversed near the 0.50 level, which qualifies as a valid pullback. As soon as the price breaks below its earlier swing low, we can mark this as a break of structure and shift the previous swing high forward to the new swing high. In this way, both break of structure and change of character are plotted on the chart. Let's now examine how to identify strong highs and strong lows. When the trend shifts into a bearish phase, the swing high formed just before the change of character is considered the strongest high, since this level will act as major resistance in the future. Breaking through it is often the toughest challenge for the market, as it carries the highest resistance. Most sellers place stop losses at this level, and because of the strong selling pressure, it becomes difficult for price to cross it. Therefore, this level serves as a strong resistance zone going forward. After a break of structure on the chart, when the market retraces, price action continues trading within earlier swing highs and swing lows. The swings formed during this phase are called internal swings or minor swings. These structures appear mainly to capture liquidity from retail traders, which is why we should avoid making trade entries inside such internal moves. Many retail traders find it challenging to distinguish between the pre-trend, or major trend, and the counter-trend, or minor trend. To simplify, in this chart, price is creating higher highs and higher lows from this point onward. By price action rules, this represents a bullish trend. This indicates that overall market sentiment is bullish, which means the major trend, also called the pre-trend, is upward. However, the market never moves in a perfectly straight line. For price to travel from one level to another, buyers and sellers must be given opportunities to enter and exit trades. At certain points, profit-taking by some traders and the presence of new sellers cause price to dip slightly. This decline then attracts new buyers, followed by fresh sellers. This cycle repeats, pushing the market forward with smaller retracements. The movement of price in the opposite direction of the major trend is called a counter-trend or minor trend. These small retracements during pullbacks fall under the counter-trend, and this is precisely where most retail traders get trapped. Therefore, if your goal is to achieve consistent profits in trading, your focus must remain on the major trend of the market, and your trade entries should always align with that direction. Now, let's review all these points quickly. First, the price forms a swing high and then breaks below its previous swing low, creating a break of structure on the chart. After rising by forming higher highs and higher lows, when the price reaches its last swing low and breaks downward, it then creates a lower high, marking a change of character. In this scenario, the major trend remains bullish because the price has been making higher highs. Therefore, this retracement in between represents our counter-trend. At the same time, this swing high and swing low are considered strong, while the intermediate swing highs and swing lows are regarded as weak and are also known as internal structures. This retracement is invalid because the market pulled back less than 50. On the other hand, this retracement is valid because the price created a deep pullback here. That's it, traders. Thanks for watching this video. Discipline is the bridge between goals and results, and every time you show up, you're building that bridge stronger. If this video gave you something valuable, hit that like button right now. It motivates me to keep bringing you more. And if you're new here, don't forget to subscribe and turn on the notification bell, so you're always ready when the next lesson drops. Stay consistent, stay disciplined, and never stop chasing growth. I'll catch you in the next video.